Hello, everybody. Thanks for joining episode 5 of Messari Happy Hour. This one's going to be on DAOs and governance. Before we start, here's a quick disclaimer. All opinions expressed by our hosts and our guests are merely their own opinions. They do not reflect any endorsements or opinions of their companies. This discussion is meant for informational purposes only. You should not take their opinions as investment advice, as you will be solely responsible for your own investment. Hosts and guests may hold cryptocurrencies discussed in this Twitter Spaces. Additionally, certain Messari employees are required to disclose their holdings, which is updated monthly and available at our website. I've just shared those disclosures via a tweet. Let's jump right into it. So I think a good place to start is obviously there's been a little bit going on in the governance space. We'll share a tweet here about a Solana whale and Solend, and kind of a back and forth where the whale was going to be liquidated. And basically the platform, you guys can correct me on this, made the vote for the DAO. I was told that that DAO was made shortly before the proposal even went out, and there was kind of a back forth, which has led to a little bit of a mess. So I think a good question to kick off this space is that Traver posed before we got in was, do your tokens actually matter if founders, core team members, whales hold the voting power? And what structure would you like to see, or what changes would you like to see?
Awesome. Thanks, Doug. I'll start off here. Thanks for putting this together. Super excited to be here talking about DAOs and governance. The DeFi and the NFT stuff is super interesting, but it's nice to get a little shout out to kind of the other side of the equation here. I think that's a really a tough question to answer and an interesting one to kind of explore. It's, in my mind, it's really a balancing act between where the DAO is kind of in its life cycle and decentralization and where it wants to be. I think if you look at something like Alchemix, they've done a pretty good job of remaining decentralized, even with some concentrated voting power. And then you look at some other DAOs, and it's simply not the case. I think also when you have projects that are fully decentralized and the community does own all the tokens, you kind of end up on the left side of the bell curve meme occasionally, and you get some pretty crazy ideas. We saw that with Merit Circle, where a lot of the VC's tokens were locked up. They couldn't vote, and then you had a pretty controversial proposal come in to reverse a seed investment that took place, and that's clearly the other side of the equation here. So I'd be curious to hear what everyone else kind of has to say on this topic as well.
I think it's like a very interesting like shell game played almost as well. So kind of specifically to the case of Solend, Kobe had a pretty funny tweet where there was a whale about to get liquidated. It started the whole concern for do we OTC this whale's funds instead of like essentially destroying all sense of on-chain liquidity. And I believe that position was around like the $10 million mark. But then for the actual governance vote, a smaller whale, I guess, came through with about $1 million worth of Solend and just dominated the entire vote. That was the only vote that was cast that mattered in any sense. So, like, I guess every whale has a whale that's bigger than them. There's always a bigger fish. But like, who? It's kind of strange because if so for reference to everybody else on this Twitter Spaces, I'm on the data science team at Messari, so I spend a lot of time like looking through protocols and metrics and that stuff, and one of the things you'll find is it's all dominated by whale behavior, right? Like if you look at DEX volume on Uniswap, unfortunately all that matters from the protocol perspective is the whales. If you look at lending market volumes, pretty much all of a huge chunk of Aave is just Justin Sun himself, right? So like, if I was Solend, you kind of want to attract the whales, right? So are you going to attract whales by having smaller whales wash them out? And then if whales are the only thing that matters, does it matter to you that like the users don't really have a meaningful vote? Like that's kind of the harsh reality of at least what the on-chain data says, but I'm curious to hear what other people think.
Well, I like the fact that I think we're lucky that Solend didn't go ahead with the vote, because that would have set very terrible precedents. But then, if you think about what has happened in other protocols, for instance, PAP protocol, similar thing happened when a whale was just trading on the cream market, and liquidation just caused this cascading for the whole exchange had to be shut down. Well, if you think about it, they were actually trying to prevent something that would have turned out really badly for the Solana market. But then on the other hand, we're also going to think about the kind of precedent you have set. And for that reason, I feel like to an extent, or I don't know, but I think it was worth it that they were going to set those mitigations, because it was for the greater good.
Yeah, and excuse me. I'm Aiden. I work on our Intel team, but I think an interesting component of the Solend vote, when you look at it in a vacuum, the proposal passed. The token holders who felt like they had an opinion on the topic did cast their votes, and it was overwhelmingly in favor of it. And the social consensus around it, even outside of actually the token holders themselves, is really what kind of motivated the Solend team to put up the second proposal to invalidate the first part of the proposal. But when you consider just the token holders in a vacuum, away from this kind of social consensus and this kind of pressure that was put around them on Twitter, it's very difficult to kind of understand where kind of the power actually lies. If this was a bigger protocol, would kind of the forces on Twitter and the community outside of the token holders who voted, would they have been able to have as much influence on it? And again, if this hadn't become such a topical or such a large kind of focal point for a lot of just crypto people in general, I think in all likelihood you probably wouldn't have seen the second proposal go through. So I think it's really interesting to consider what the actual power dynamics are, if it isn't actually the token holders who have consistently voted in favor of all three proposals that have been put forward. And I think it's probably just a pretty good representation that, for just looking at Solend, that maybe token holder governance doesn't necessarily reflect the best interest of the Solend users. And I think also, I think a lot of influential people in the Solana ecosystem have had a lot of views on the space, and just by nature of Solend being a Solana application, there's vested interest to make sure that this project doesn't do anything that could be viewed as rash, or even if it's a separate application that has nothing to do with the Solana team or anyone building on Solana. I think there's a lot of other dynamics at play that are difficult to really quantify.
Carl, I think you made a good point in Solend kind of doing what was best at the time. And this maybe leads into a couple questions that Traver asked. How do you fix this issue? And does it make sense to stay centralized and decentralize over time, or is it kind of a case-to-case basis? And then maybe a final question is what's the point of these tokens then?
With the governor team, I didn't have you saying that earlier. Well, first of all, I want us to think about other governance. Well, not other, but specifically Liquidity. Liquidity is a governance-free protocol, also lending protocol as well. And we know how far Liquidity has been on how long Liquidity has been in DeFi. So it's a protocol that has been designed to be able to withstand any kind of form of liquidation. And you look at the mechanism, the way the protocol works, it does very well without governance. It's reachable, but Solend hasn't gotten there yet. And there are a lot of other protocols as well who very likely haven't gotten to the stage where they can actually stay on their own as decentralized protocols, if we are really talking about what it means to be decentralized. So there's still a lot of innovation that many protocols are going to go through. There's still a lot of development that will go through, and all of those will happen in due time. But right now, if we are going to give a lot of powers to to tokens, then we want to see that everybody, or want to see that all the tokens are out there. And by what I mean is, we want to see that all of the vesting tokens are already vested. We want to see that. We just want to know that there's nobody who still have tokens, who is still vesting. There's nobody who is still going to, in one way or the other, easily manipulate the market, because we don't know what will happen in the next 6 months, or in the next month, or even next Thursday. But if we get to the extent where all these tokens are vested, well, certainly there are certainly kind of protocols who actually take a lot of time to do that. Like Call, for instance, that's like 300 years to come before that happens. But well, we all can see how much we can see how much is important for certain kind of decisions to be made at certain levels without just relying on token holders, because quite frankly, we can't give all the power to token holders, in my opinion.
Yeah, I think there's also an interesting question here of like governance design, right? So even if a whale does come in and sway a vote that might not be in the best interest of the community, what mechanisms can you kind of build into the governance system to either make sure that that vote is properly reviewed? Do you have a multi-sig backstop of other industry stakeholders that do not have a financial obligation to the protocol, who can kind of review that and, on 8 of 8 consensus, vote to overrule? Is that fair? On the flip side, if you have, a proposal that is passed that goes against a whale and a whale wants to come in and reverse it, do you want to be able to have proposals be reversed if they're being executed off chain, or do you want proposals on chain always being executed depending on how they're passed originally in a first vote? So there's kind of multiple layers here of consensus and then execution, and then the potential reversion of that execution that I think could be solved more elegantly for a lot of these protocols at the design level.
Now, all of this begs a bigger question. What kind of governance do we really want? Because so far everybody has been talking about wheels and who owns more token, who has more voting power for a protocol. So maybe the question we should be asking ourselves is, what kind of governance do we want? How much do we want the governance to develop beyond just having few people being able to, change the direction of a vote? Or should we be using a different kind of voting system? Should we be using quadratic voting? Should we be using one wallet, one vote, and try to cut out all the cyber attackers? Should we use NFTs instead of tokens? Should we use soul-bound NFTs? All of these are decisions that we could consider if we want to fix some of those challenges. But right now, as long as certain people are going to hold more control over certain protocols, in my opinion, beside the fact that the only alternative to the kind of system we have right now could probably be delegates. And we know very well all these protocol politicians, we set up delegate system where we know we can rely on certain delegates we can speak to, or certain people who can actually think about the benefit of the protocol whenever they're making decisions. So when there's a whale per se in court is trying to threaten a protocol, and then we could actually garner support from delegates who will actually protect the protocol. Besides that, we're just going to have protocols who will be prone to governance attack, and we don't want that.
I think the delegate model has been like a decent stopgap to like some of these bigger questions, because I think it's all, honestly, I think the reality is we'll just try it all and see what works, as far as like, one wallet, one vote, soul-bound NFTs, all that kind of stuff. And then, I guess different DAOs will just by nature have different governance structures. And that's probably a positive, right? That like one DAO feels, we shouldn't have a governance structure. This is just a fee share token or a part of the community fund token, but none of you get a vote. It's just the team. That's fine. Like, as long as I think the big thing is as long as it's transparent, right? Kind of know what you're signing up for, then that's fine. And in the meantime, the delegate system, ENS, I remember claiming that airdrop. And then, like, it had me select a delegate beforehand, and that's something that, like, is a good idea, is to kind of remind users that, hey, we know you're probably not going to be all that checked in and all that engaged. Here's a list of 10 or 20 people that the team likes, the Discord community has kind of elected. If you want to stick in a custom address, absolutely go for it. If you want to be your own delegate, go for it. But I really do think the delegate system is at least a pretty big step forward, and I wish it was much more widely adopted.
Do you have Mike, do you have any concerns around with the delegate model? I think one of the things with MakerDAO, for example, is they've pretty much transitioned all of their operations onto pretty much a decentralized governance operations, where they have anywhere from 5 to 20 governance polls a week, and they'll have an executive vote thrown in there too. A lot of the parameters around the governance and the governance votes has become really granular. I think just in general, very technical, where these delegates are now probably some of the only people who really have a strong insight into where the direction the project is going. A lot of the conversations that they have, not that they are by nature centralized, but when you create kind of these working groups, I think even if it's not explicitly centralization of the token holders and voting power, I think implicitly the collaborators and kind of the voices and the people who are able to voice their opinions becomes a smaller group. So I was wondering if you think there's any downsides to that delegate model and just kind of these slow buildup of implicit barriers that separates token holders from the governance process of a lot of these protocols.
Honestly, that's a really good point that I hadn't thought like too deeply about before. My like initial response would just be, it's a mismatch, right? Like, I know it's a little bit of a cop-out answer here, but to say like, okay, if we need, if you need some technical level, just abstractly technical, and then MakerDAO specific technical level to have meaningful like input on some of these proposals and metrics and coefficients that they're, tweaking and playing with, then honestly, maybe that shouldn't be a governance thing. Maybe that should just be like a team in-house protocol thing, and we all kind of open up to the idea that not everything should be governance. It's fine to have like just some people control some things and then kind of trust them to get done, or the DAO maybe sets up the structure to get those people in place, but then they're less subject to delegation, almost like we're about to recreate Congress or something like that, right? You've got a year or two, and then if things go unbelievably crazy, the DAO has the right to like veto you out or something like that. But no, that's a really good point. Do you think, actually firing it back at you, do you think it's almost inevitable that all DAOs kind of drift to that? Because I know the MakerDAO, that whole team and organization, they're hardcore, right? Like they really go for it, and I think we all love them and admire them for that. Do you think, like Aave, Compound, as they mature, they're probably going to get more hardcore? Even decks like Uniswap or Sushi or something, pretend they really start to tweak in metrics and hone in finer parameters. Do you think it's inevitable that there will always be some technical high knowledge barrier to a truly mature DAO?
Yeah, I think part of it too is understanding kind of the granularity that you want to go into with governance. When you think about kind of like a lending protocol, maybe Maker's not probably the best example for having a large variety of kind of collateral assets, but maybe something more like Balancer, where you have all of these individual pools. They're like, you're not going to get any sort of meaningful participation if you're going to vote on changing the specific pool parameters and every kind of minute fee thing. where I think there's definitely a pretty good case for some sort of automated third-party resource that you go to. Maybe it's something like Gauntlet, where they're able to actually do some sort of simulations, and the protocol themselves can grant them that access. And I think part of that too is the transparency of, if you're going to go to a third party or a third party consultant, that the models and the simulations that they're using can be audited. They understand what the inputs are, and the outputs are predictable. But I also think another part of it too is on the voter apathy thing. One of the things that MakerDAO has done recently, I want to say within the last 6 months, has actually started to incentivize these delegates, where I think anywhere up to $12,000 a month, and it kind of sounds like a crazy number, and I might be off a little bit on that number, but a lot of these delegates, it really seems like the amount of work in the forum posts and how active they are, that it is a full-time job, and they're working not just within the other delegates, but now with MakerDAO, you have all of these core groups. So you have to facilitate the conversations and the responsibilities across there, where if you are going to go kind of that hardcore in the sense of decentralization, I think you have to add that extra layer of incentives on top of it. And delegates who are accountable seems like a pretty good solution in that case.
I want to jump in on this. In terms of protocols, I think that we should pay attention that the whole DAO ecosystem is still like less than 5 years old. So this is actually very, very young ecosystem that's still trying to understand how to approach governance. And besides that, there's a very huge gap between what people understand on how a protocol works and how it actually works on the technical side. Many people don't really many people don't understand solidity. Many people can't read the code, but they know that I can interact with this thing and I can, put in my ETH and I can withdraw USD and I can pay back later. Like, that is the basic knowledge they understand. Now, we have delegates who probably have core understanding of how the technical side works, or we have delegates who can interact with ordinary people who are easily more accessible than the core team. So if we are thinking about when I think about where delegates will go to how to develop, I see a system where, in my opinion, because now we are talking about protocols, there are a lot of other, there are other collector DAOs, there are social DAOs where some of these things don't apply. But in terms of protocol DAOs, in my opinion, right now, we could have more delegacy. We could have more delegates, and as the structure develops, they are going to be replaced by sub DAOs. They are going to be replaced by more, like right now we have delegates where people are worried about this person is having too much voting power or having too much control. We don't want to replicate. We don't want to replicate, should I say, everyday politics system, but that is essentially where we'll try to just gain some lessons from. Where I see us going to as we grow is, right now we have delegates who I can give my token, who I can delegate my voting power to vote for me, and then we'll get to a situation where the protocols can establish sub DAOs around their delegates. So we are discussing with the delegates. We are not just chatting on Twitter, or we are not just we are now discussing with the delegate as maybe as a service provider to the protocol, and then we are now concerned about protocol. We are not concerned about transparency. They were not concerned about an alternative to the person being a delegate, probably something like a council system. And also, council system have worked very, very well for very technical protocols like synthetics, the graph, and I think even Illivium. Those systems that use council has worked very well because they are very specific people who are concerned about doing the hard thinking and making the choices of vote. And when we think about how we can incentivize those people, I really don't think that any amount is too big, because right now we want people who are dedicated to this thing because it's a job, it's a full-time job. Thinking about how to tweak parameters, thinking about how to just thinking about how these protocols work. These protocols hold billions of dollars. So we don't want to start saying we are mising on money, because how much have we lost to hacks between January and now? A lot of money. So we want people who are actually giving all their time to this, who are thinking critically about it, how it works, and then they are paying all the attention that's required. As we grow, as the ecosystem develops, we can now decentralize those people into group of people. So that is my opinion, and I hope that many protocols are also thinking about this the same way, because if they really do, then that's the best way to actually decentralize the protocol from delegates to council, or if not council, then sub-DAOs.
Yeah, I think it's kind of this idea of like we're speed running finance on the DeFi side of things, and we're just gonna figure out what works. We're speed running governance, and it is pretty clear to me that most forms of governance, whether corporate or institutional actual government, it is some sort of representational democracy, or elected officials, or appointed in the sense of most businesses. I think the core innovation here that gets really interesting is the liquidity of voting. So at any point, if I'm a token holder, I can switch who my delegate is. So I think there's some really cool opportunities that we haven't seen fully developed yet, where let's say blockchain at Berkeley is a whale on a certain protocol. They can actually choose to delegate based on certain areas, whether it's operations to a certain delegate, whether it's treasury management to a certain delegate, whether it's parameters to a certain delegate, and have them almost instantaneously accountable to their voting power. So they don't need to go in the weeds, but if an issue is raised, they can react extremely quickly, whether on that vote or the next vote, to kind of move their position. So I think that aspect of it, I'm really excited to see continue to develop.
Actually, I really like what you just said about like your point started with we're speed running governance, and we might just land kind of where we're currently at, which is some sort of like delegated or representative. And then I kind of thought to myself, I was like, oh no. I was like, we're back. Congrats, we're back to square one, except we're now inefficient because we're on a blockchain. But actually what you just said about like, you rolling with the Berkeley example, like them being able to quickly switch and say, hey, this proposal is really like an in the weeds technical proposal. Aiden is super in the weeds on this protocol. Let's delegate to him and follow his opinion on this. Oh, this proposal is much more community oriented. Let's delegate to this person who's like a super active mod in their Discord and in their Telegram, so they really have their fingers on the pulse of the community. I think that alone is an upgrade to the current system. If it is just a current system plus that, I would hope that's an upgrade. But then point two that I'll make is not everything has trended to democratic representative governments, right? Like there are still literally countries that are monarchies, right? There are like weird coffee shops in like Oregon and SF that are anarchist flat structures, for better or worse, right? So I think there is still room in the design space for that kind of stuff. And then I think at the ultra high level, it really depends what you're optimizing for, right? Like if we think that the purpose of a DAO is to be profitable, and the token holders are most analogous to shareholders, then honestly, Solend should not have removed that whale, because you look at their TVL and their Solana denominated TVL, so roughly adjusted for token price, it's down like 50% in a week. They've essentially signed the death warrant of their protocol because no whale will touch it again, and whales are the only thing that matters, right? So they should have said, screw Solana. We don't care if it absorbs the rest of the liquidity on the network. We can't betray our whales. If the purposes of these protocols are more Uniswap style and optimism style, and it's more about public goods and all of that stuff, then it's probably a good thing that those tokens don't have financial incentives, and they have large grant programs, and they vote to shape the course and all of that. So I kind of like where you went with all of that.
maybe this is a nice transition point, Mike, with your point that something like Solend being denominated in Solana, and I know Traver and Caro had thoughts on this, but let's talk about treasury diversification for these DAOs, and how that might be beneficial.
I'll jump in because actually we've been having lots of conversations about this recently, just amongst ourselves. One of the really interesting things is like I don't think you can run a DAO treasury in the same way you can run a corporate treasury. One, because for all intents and purposes, your corporate treasury is pretty much denominated in the currency you pay taxes in. Right, like if you're mostly paying taxes in the U.S. dollar and you're listed on the U.S. exchanges, right, then that's kind of like you denominate your treasury in the U.S. dollar, and then if you have foreign businesses, you FX hedge responsibly. If you're based in Europe, you might do it in euros and FX hedge responsibly, all that stuff, right? But then two, like Uniswap holding a ton of Uni token or their team holding a ton of Uni token, it aligns the incentives, right? Like I know crypto natives, if I was using a DAO and all of their treasury was in USDC, I might think to myself, oh, they're responsible, but they're not like in their own community, right? So like the community in crypto, as we've learned, you don't want to piss those guys off. So unfortunately, there is a positive outcome of the DAO being a bag holder of the DAO's token, right? So I don't have an answer, but I think it's a very complicated question.
Well, the first thing we want to understand is that is almost bound to happen where the DAO is the biggest bag holder of its own token. It's bound to happen, right? I mean, you're minting USD. Of course, you're the biggest bag holder of USD. That's why the US is the biggest bag holder of USD. Now, I think when I think about this is what comes to mind is this. I think the Japanese called it the karashi or something, where companies own portions of each other. So we had a lot of token swaps and partnerships happening in early November into December when we were tracking proposals. And I was speaking with Traver about it, and I said, this is because we're in a bull market, but then the moment we got into the bear market, nobody was swapping token anymore. Everybody, I mean, there was even like this Bankless proposal. Sorry, Bankless, I'm doxing you guys, but I mean, they went to Frax to do token swap, and Frax was like, no, this is not happening. And Frax is a stable coin, right? Now, but the thing is, I want us to think about it this way. If protocols are going to own portions of each other, everything gets interconnected, and really is going to affect my back, because when my Wi-Fi dumps, then I know Wi-Fi owns some Bankless DAO tokens. That means my Bankless DAO token will probably dump because they will sell Bankless tokens in their treasury to buy for USD, and then maybe 1inch will also dump it because 1inch also owns some Wi-Fi. Now I don't want that. I want to invest in assets that are not, correlated. You get, and that's why I'm really bothered about the fact that Bitcoin and Nasdaq is going the same way. I don't want to see that happening. I want to know if I have some money in Bitcoin and I have some stocks and they are not going the same direction. At least give me some. That's why I'm diversified. That's the whole idea of diversification, right? Now, and that brings us back to real world assets. So we have a situation where a lot of DAOs are just having treasury assets in tokens. Why don't we have these DAOs investing in outside of the blockchain? I mean, you want to impact the world. Why don't you think beyond just finance? You want to impact the world. You want to build a very strong treasury. Then, of course, you have a lot of DAOs right now who are setting up legal entities. Then let your legal entities own assets outside of the blockchain. Let your legal entities invest in And just do some investment outside of blockchain if you want to diversify your treasury. Maybe it's not going to be as liquid as it should be, but then you always have USD. So when the market dumps, you know that you're stable, and you always have something to fall back on if everything comes crashing down. Because if Bitcoin comes crashing down, the whole crypto market comes crashing down, and you don't really want that. You want to be in a position where you can still fund operations. You want to be in a position where you can still pay your contributors. You want to be in a very strong position for years to come, not just for 2 years. Not just I was looking at a tweet, I think, from Banteg, and I think it's a forum, and he was like, we are going to reduce all of our contributors' pay, because of the bear market. And that makes sense. Yes, it does. But then on the other hand, there's some kind of investments that if Wi-Fi has done maybe a year or 2 years prior to this time, they will not feel the effect of the bear market, right? It's going to be a case where it's just going to be like any other time, because they were expecting it. But I think it's bringing me back to my point earlier. The old DAO space is still 5 years young. So maybe we should give time, and then they will develop beyond just holding tokens as part of their treasury. Maybe we will see DAOs who are not just thinking about buying a golf course, but also buying an airplane or buying an airline. Or maybe we'll see DAOs who are not just, holding, maybe we'll see DAOs who are also investing in the stock market, because if you are going to hold tokens, why don't you hold stocks as well? Buy a portion of a public company, and know that you are going to make very important decisions and influence what's happening in the stock market. And whenever I think about treasury management, I just know that it is something that requires a lot of expertise. And quite frankly, I don't have that expertise, because if I look at my portfolio, I can't really be proud of it right now. So that means I don't really have a very strong opinion on this. But I do know that those that want to take the opportunity to build expertise in treasury diversification or treasury management need to think about ways to invest outside of the blockchain. That is one. And they have to think about having not just 10% of their assets in stable coins. At least think about 25%, think about 30%, 40%. That is what the DAOs who have lasted longer, that is what they do. That is why we have MakerDAO surviving, because they have DAI. DAI is a stable coin. And that is why we have Aragon, for instance. I think the bulk of Aragon treasury is a stable coin. The bulk of BitDAO is a stable coin. Many of this, if we think about these guys and their treasury, and we see the fact that they are hedging against all these assets that are easily prone to volatility, they are in a more healthy position. So we want to. I just feel like as we grow, people should think about less volatility, because you get to a point where you are no longer. There's a certain amount of money you have, and you're no longer thinking about making more money. You just want to not lose money. So that is what DAO should be thinking about. So that is my opinion.
I think your point about the versus kind of a bull market, bear market in terms of kind of treasury swaps between protocols. And I think treasury swaps in themselves are a little bit of an odd thing. I think there's one part of it with kind of just in the past year, the first examples when you think of treasury swap, most of the protocols that were swapping treasuries, while it might have been under the guise of kind of diversification of the treasury, I think a lot of it was how generating more yield on other assets, or some sort of gauged weight voting, where they were using these tokens for bribe voting, where the kind of the incentives of the token holders, the token holders in most cases don't actually have a claim on the treasury. Most of these DeFi protocols, it's on a very efficient system where, if it's trading below the treasury, we'll do some sort of buyback, or above, it's at a discount or a premium. And I think in reality, most of these kind of token swaps were, if you're a token holder, it's not even necessarily geared towards a token holder, but being able to boost the yield that you're providing on these different protocols, where you then kind of down the line, you have the secondary effects of increasing the liquidity in the TVL, and you see other health metrics go up. But outside of kind of just dollars or a stablecoin equivalent, and maybe there's an argument for Bitcoin not being a correlated asset. I think it's a hard argument to make that a lot of these treasury swaps between protocols actually kind of align the incentives, or really was skin in the game, where I think that's where you see a lot of that inefficiency, and why it was so prevalent in a bull market is due to the fact that everyone was trying to juice these yields and figure out different ways to do that. Where I think that's a component to consider when you're talking about swaps between protocols and their treasury management.
Yeah, I really like what you were saying, Caro, about blockchain assets as well. I think that's something we're going to see more of once the legal structures get more defined. Right now, I think a lot of DAOs are kind of scared of the regulatory environment, and I think they're a little hesitant to go beyond kind of the Play-Doh money in some sense. I do think that when we talk about DAO treasury management, it's certainly different, like Mike was saying, than traditional treasury management. I think you have a whole nother issue to deal with, in that you have the token supply, which is much more liquid than like stocks or private ownership of a company, right? Like that is your primary asset. So looking at capital allocation and being efficient with your token supply and how you're allocating that token supply is kind of a new, it's a new framework for treasury management that I don't think has been optimized much at all. And I think we're very early in kind of seeing how liquidity is managed moving forward in terms of native liquidity, what that looks like in terms of token swaps. Like that's clearly part of it. If all your capital is wrapped up in your native token, you're going to try and diversify by trading with other DAOs who are willing to do so with their most, voluminous asset as well. So I'm just kind of curious to see, as we move through the bear market and come into the next bull, how we look at token supply and how DAOs are either more stingy or more liberal with what they're holding.
What do you think about there was a while back, probably more than a year ago at this point, like a Yearn proposal. It was something along the lines of like, buy the land, like McDonald's is really a real estate company or something along those lines. How do you feel about like, if you're a protocol on ETH, your credibly neutral asset is Ethereum, right? If you're a protocol, I understand this doesn't hedge you against like the USD risk, but as just a super crypto axie, maybe it is actually more true to form if like protocols on Solana like just don't accrue revenue to the token, they accrue revenue in Solana, and then as Aiden said, they become more sophisticated about the relationship between their token and their treasury. And then, they don't necessarily have to be so active about the token. The token can dissociate some way and maybe create cleaner governance incentives as well. But, you're on Solana, so screw it. We're just going to try to get Solana. The same way, like the point of Apple is to make dollars, right? The point of Berkshire is to make dollars, right? Because they're on the dollar network, right? That's their blockchain is the dollar system. So what do you think about just like, let's be crypto purist and let's just denominate in the native asset? And then you could even think deployment wise, right? Like if Yearn deploys on Phantom, it'd be kind of cool if like the Yearn Phantom deployment really just tried to acquire a lot of Phantom, and Yearn ETH deployment really tried to acquire a lot of ETH. It's like going to another like domain of operation and like aligning those incentives with the base layer. Because in theory, the base layer is like a credibly neutral asset as well.
Yeah, I think that makes total sense. I think this is where management part of it comes in, right? Like, what is our roadmap what is our runway that we're trying to build? Is it 4 years? Make sure you have that in a more stable asset that you're willing to hold when the ship goes down. And then like, what is your strategic outlook to building your, liquidity Silk Road, for lack of a better term, to move to different chains and kind of expand your ecosystem? So I think it just comes down to getting the right people in place to make those decisions and kind of see the whole big picture. Because right now, even a lot of the service providers coming in and doing DAO treasury diversification management, they're taking a percentage of yield off of what they get from managing these treasury assets, which in my opinion is a complete misincentive to be managing a whole treasury. And I think we're going to see that change as well through the bear.
Okay, so just like I said before, I don't have excellent expertise in this, so I'm not having any strong opinions. But this is me giving an advice. So if you're building a protocol, please don't have a fixed supply. Don't cap your supply. Just you want to make money. You're not Bitcoin. Don't set 21 million XXX tokens. No, don't do that. You are never going to have the kind of, your token will never be worth $69,000. That is just a fact. And maybe in some alternate universities with an alternate universe with max inflation, your token will be worth $69,000 at peak. That probably happened. Good for you. But the fact is, my advice for you, if you are building a protocol, don't cap your supply. You probably want to set up a system where tokens get minted. Maybe when some certain parameters kick in, or maybe after a certain number of years, or after a certain number of months, or maybe based on activity around your protocol goals. That's what you want to look out for. But what you should look out for, in my opinion, is build a war chest. Have as much stable asset as you can gather. If you want to gather, a base asset like ETH, because ETH is an operating system, a lot of applications will be built on it, which makes the more applications, the more value it has. And if you want to gather ETH, then good, gather ETH. If you want to gather USD, then do that. But then your token should be something you mint whenever you need money. Like at the very in a situation where you are pushed to the wall and you really need to do this, then you should mint tokens. But never say you are going to cap your supply. That is not a smart thing. That, in my opinion, that is not a smart thing to do, because we've seen many times that supply and demand the fundamentals don't really matter in a bull market. That is a fact. So supply and demand don't really kick in. Supply and demand kicks in bear market, and you want to be ready for bear market. So in the bull market, if you have any amount of token out there, it's going to appreciate. And when it does appreciate, you can always sell it for a more stable asset and build your treasury.
Let's shift real quickly. Speaking on the topic of incentivizing contributors, I know, Traver, you put a point on vote escrow tokenomics and revenue sharing. You asked the question, is this the new default tokenomics for bootstrapped DeFi protocols? And do you have any good examples for us? Traver, you're muted.
Thank you very much. I think this question kind of comes from Caro and I working on Governor and tracking what seems like a always growing list of DAOs that are adopting the tokenomics. So we've seen this from Balancer, Redacted Cartel, Goldfinch most recently, and it really seems to be kind of the new gold standard for tokenomics. So I just kind of wanted to hear what everyone's thoughts were on that, what their thoughts were on kind of like the base plate thesis of incentivizing other DAOs to come and have a stake in your token emissions, and revenue sharing, and what that creates for token holders.
I'll come through here with the hot takes. I'm not huge onto the VE model. I think like this comes back to kind of a running conversation that's been happening across a couple of these a couple of these happy hours, and just I hope the conversation picks up more steam in crypto Twitter as well. But it's really, really hard to defend a moat in crypto. And I think because of how technically high the barrier is, because how niche we are, because how inefficient it is, there's a lot of protocols that can currently extract a fee from their protocol or from their users that are not going to be able to once you like grow and mature and hit a more steady state crypto economy. I think at that point, like why, this is why Uniswap is, let's be real, like the penultimate DEX, right? Is because they don't extract that heavy fee from people doing swaps just to pump Uni token. They can offer fees at essentially bare minimum to attract LPs, but no more to rev the token. So I'll make like the bold claim here and now, like any other DEX that has a fee extraction model, unless they can offer meaningfully more liquid swaps than Uniswap, I don't see them being able to compete. And then, if you're offering more liquid swaps than Uniswap, more concentrated or capital efficient liquidity, what's stopping someone from forking you and putting zero fees on it? So I think the VE model is a death wish. I think it builds wonderful flywheels. It builds great pumpamentals and all that kind of stuff. Like good token, bad protocol is my mindset on that. And I think in the end, I choose to believe that good protocols will win out even on top of even against like good tokenomics. So I am not at all a fan of the VE model because I think it in-bakes inefficiencies into your protocol. It lowers your ability to compete.
I really want to hear Adam's view on this because I think he has a lot of knowledge on this. So if you share please, Adam, say something.
Yeah, I wouldn't say I have necessarily that strong of a view on the topic, but I definitely think it feels like in terms of kind of what the model of success that we're basing it on, it's difficult to say kind of has the VE model contributed to the success of X, Y, or Z project when there's a lot of other it's difficult to look at these projects in a vacuum to say that these are good. This is like a long-term fundamentally good thing. I think in a lot of ways what it provides a good short-term kind of placeholder or a band-aid that can prop up projects. And I think maybe part of that is it's not necessarily great for a project to do after it's kind of reached a certain level of maturity, but in itself is a bootstrapping mechanism. I think kind of being able to have those initial commitments, and maybe it depends on what you want to limit your max commitment, whether it's kind of 4 years or you want to reduce that time scale where you can revisit the governance part of it. But I also think it's interesting just to have the governance tied so closely to the tokenomics of a project. I think also adds a little bit of noise to really providing a strong analysis on whether this is a useful or a long-term beneficial thing. And also just because it has become so trendy, I think there's not a lot of people speaking to the kind of the counter arguments around it and other possible solutions or replacements for the model.
I think that's a really good point about like the price creating like false signal, right? Like how interesting is it as a protocol to like not design a good protocol, but design wonderful tokenomics, and the price is mooning, you're paying people out, dev team's happy, VC's happy, everybody's having a grand old time, right? And then, the bear market comes and you realize, oh no, like one, reflexivity always works both ways. And then two, you've tricked yourself into thinking you were doing a good job the whole time. So, not to pick on people because I like go back and forth on my long-term opinions on Ohm, but this is almost the picturesque, right? They basically built a protocol that like holds an LP. That's what it does, really. It's like it either holds the Ohm DAI LP or it holds some Olympus Pro LP. It's bag holding as a service, whether it's their own bags or someone else's bags. And they built just insanely good tokenomics. But, reflexivity goes both ways, and now you've built good tokenomics on top of, I'll leave the debate out, but what the market is treating right now as a bad project. So it is a very noisy signal. And I think you can always revamp tokenomics. You cannot always revamp like a protocol. So
the V model wants to it wants to reward people who have committed long term with the protocol, right? And quite frankly, I can't think about an alternative to the V model if that's what you want to optimize for as a protocol, because except you want to introduce something like safe moon tokenomics to your protocol and just safe mooning everybody that is holding your token so they can continue to vote for the benefit of your protocol development or one way or the other. There's really any other incentive for you to know who should be earning tokens besides those that are committed for the long term. So that's where V works. That's where it thrives. So when you talk about V model being like a dead wish for most protocol, I'm wondering like, okay, what is the alternative, Michael? Because that is what I want to hear. Like, what is the alternative?
I think my alternative here is to build a good protocol with a defensible mode. So I think one, as far as time locks are concerned, a more strong language here, but I personally think it's insane. Like, are you kidding me? Like, are you time locking for 4 years in the most rapidly developing, changing, growing ecosystem in the world, right? Like, when did NFTs pop off? When did DeFi Summer pop off? All of a sudden we've got Cosmos chains, and then now we're doing soulbound NFTs and social graphs and perps or tokenize this and that. One, I just think any 4-year lockup is just crazy. I think it's god-awful risk management, to be honest with you. I'd way rather see VCs take that risk than, retail or something like that. That's really where it comes in. But back to like the actual tokenomics alternative to VE, build a protocol with a defensible moat, right? Maker having sufficient brand and systems to like lend against real world assets, that's a moat. So it makes sense for them to accrue value back to the token through Maker buybacks. Yearn having a Lindy flywheel effect of aggregating brain power for strategies, and sometimes the yield is good, sometimes it's not as good, but being able to get reasonably consistent yield on billions of dollars with updated strategies and risk managed and monitored strategies, that's a defensible moat, right? But Uniswap's moat is that their fees are absolutely minimized, right? So I think, again, the solution to tokenomics is just build a good protocol, and let's all worry about tokenomics a little further down the road.
Okay. First, full disclosure, I own Wi-Fi, so I'm a big supporter of Yen. Like, I'm a big supporter of Andre. As a matter of fact, I mean, when I was getting into crypto and I decided to invest my hard-earned money in anything that wasn't Bitcoin, the first thing I was looking out for was who are the biggest names here, and I read about Andre and I started buying anything that had Andre in it. So that was how I became a big holder of Ep5 and Yen. But my Wi-Fi holding is not looking good right now. And Wi-Fi it really doesn't have the best yield. Let's just be honest. Sorry, Wi-Fi. Sorry, Banteg, if you're listening to this. But the truth is that I don't know when they are going to release the V2 and migrate to the V2. Maybe that's when it's going to be good. I don't know. If that happens, excellent. I just saw a proposal where Alchemics were already setting up votes for ETH. And that means they were using Wi-Fi Yen before. Now they are going to be using ETH. So that means they agree with me. I'm not the only one holding that opinion. Back to the point about tokenomics. If we really want to build a good protocol that is having all the modes, then we'll probably build a protocol that has no governance. we'll probably be talking about liquidity because, and if we talk about a protocol like liquidity that is immutable, then we'll also be talking about locking your tokens, but then you can unlock it anytime you want. So even though you are not locking your LUSD in the stability pool for 4 years, you can lock it for any time you like, and you could unlock anytime you like. Now, back to protocols that require you to lock for 4 years. Now, for Curve, let's not forget that the idea of you locking your tokens for 4 years, you could actually get more tokens that will surpass the number of tokens you've locked, and those tokens are liquid. So the risk aspect kind of balances out if you think of it. Why it balances out? Because people who had very strong conviction on Bitcoins and and those who are wheels of Bitcoin right now, they've held for more than 4 years. So if I was going to get into Curve, it's because I have conviction in Curve, and then I'm going to hold CRV. Now, the Convex came and it gave me an alternative to have my locked up Curve to be liquid. And there are a lot of V model who are going to come up tomorrow, not just today, and they will not have the alternative of Convex because probably many people will not care about it. So in terms of V tokens, there's really no alternative to locking if we think about it really, because the only way you want to show conviction for supporting any protocol at all is for you to lock your asset and tell me that you are going to be paying attention to this asset, because wherever your treasures is, that's where your mind is. So locking will always be part of a tokenomics that really works. Because if you are going to have a tokenomics that is different from that, then I don't know how we want to avoid whales in the long term, because we don't want a token that has maybe 100 million supply. At the end of the day, we are distributing it to only 5 people. That will probably just dump it into the market at any time they feel like it. We want to know that we are distributing the tokens to the people who have the strongest conviction, who believe in the protocol, to lock their tokens and hold for a long period of time. So maybe there will be a lot of designs. Like there was this, I can't remember the name of the guys right now, but I think they called it the RE model, Dymo something. It was supposed to be designed to have both lock future and voting power. Kind of voting power should be independent from the locking feature. I don't know how they were designing it. I can't remember. I don't know if they went there with the token design, but maybe with people who are thinking about ways to disrupt the industry beside the VE model. And when those people come up with those excellent and great ideas, we'll have a lot of adopters, but it's going to take probably another year, because even right now, V model has been on for a long time, but it's only recently we started seeing a lot of adopters, and they're adopting it because they see that it works. So maybe if another protocol comes up with economics that people think works, then in 2 years from now, we begin to see that becoming the trend. But if that doesn't happen right now, I'm sorry, Michael, but right now the best model is actually V.
I'll just say one last piece here. I think that I lean towards Mike for sure on this. Although I do have nothing against VBAL tokenomics. I think tokenomics are just really kind of pushing the edge of incentive structure, and we're going to continue to see more innovations, and something else is going to be sexier in 6 months than it is now. I think, to kind of Mike's point, looking at brand and a moat, in my mind, security is kind of the only moat, and security is brand. So I think, the protocols that have the best security will inherit the best brand and will inherit the market share at the end of the day. But this was a great chat. Thanks, guys.
Gentlemen, thank you. For everybody listening, we will be back not next Wednesday, but the week after. That would be July the 6th, 4 to 5 p.m. Eastern. A special thank you to Mike, Caro, Aiden, and Traver for this discussion, and we'll catch you next time.